All right, what is up, guys? James here from jamesdforsythe.com. Continuing on with kind of different policy and other motivations for central banks to implement a central bank digital currency, and mostly from some possible risks is that they're also assuming. Um, I talk about negative interest rates in the title, which of course is only a footnote in the actual paper we're going to go through. Um, and there's also the whole risk to financial stability that they actually look more in depth because they are. I mean, in essence, a CBDC, a central bank digital currency, would be implementing a different form of money. Um, money, currency. Well, the differences will be left for a separate video. Um, Not something I want to get into right now, but yeah, we'll just head straight over to the screen share. And again, this is something straight from the central banks themselves. And like always, I'll leave the citation and everything in the bottom. Right. So one sec. Let me make this bigger for you guys. There you go. Okay. So one of the things that they're talking about is making basically a CBDC interest bearing. So it'd be kind of like a treasury where the actual kind of quote unquote money itself is bears interest on it. So kind of like when I say treasury, it's a liability of the government in that case that produces interest, right? And so there's one of those. You could also think of it as like I think it's the difference between a deposit like CBDC to where it produces interest and then a cash like CBDC where it doesn't. There's no interest at all. And so basically one of the motivations for them to implement such a CBDC would be for a to implement monetary policy, right? And so basically the idea is that by doing one that's interest bearing, they could more directly implement monetary policy and not have to rely on the actual banking system to follow their rate, to follow the rate changes. So if they want to increase interest rates, they can just directly do that through increasing the interest rate on the CBDC rather than having to increase bank lending rates and then hope that they do the same for the depositors, right? And so basically one of the problems or one thing that's been explored, as I say, this is where the negative interest rates come into play. So some academics have also explored the possibility of CBDCs passing on negative interest rates to the public. However, these rates could be avoided by holding cash, and if this were not available, so kind of alluding to banning cash, could encourage the public to use foreign currencies or even so-called cryptocurrency, right? And so basically trying to store your value somewhere else to where they're not just essentially stealing it from your bank account. And so much the same as like how positive interest rates will add money to your bank account, negative interest rates decrease it, right? And so if it's like say it's 10% just to make the math easy. So essentially after whatever your interest period is, like a year, say it's annualized, then after a year of just having your say $100 parked in your central bank account or whatever the case may be for however they implement this would be you'd have $90 left because 10% of it was taken out, right? Negative interest rates. Same idea, just opposite. And so it basically forcing people in a way to stay in central bank digital currencies would be a way to implement that and not have them escape it somehow. So that's one kind of risk or idea. And again, I don't want to say that and be like, this is exactly how they're doing it because they do actually discuss multiple different ways to implement such a currency. Um, and this is more of a kind of discussion paper in general to gain a better understanding of the idea of central bank digital currencies in general, right? Okay. So beyond just interest, there's also been public discussion that a CBDC used to stimulate aggregate demand through direct transfers to the public. They call it so-called helicopter drops, which I thought was funny, uh, kind of alluding to helicopter Ben for Ben Bernanke with the everything in 2008 and so on. But anyways, um, essentially government or what transfer payments, right? And so basically what they did for stimulus for the past couple years, it'd be the same thing. right? Just they would do it more directly through your actual bank account instead of having to like send you a check or do a direct deposit through your bank, which they say took way too long and it was basically so inefficient that it wasn't as helpful as it could have been, right? But they also want to put a disclaimer saying that monetary policy is not the primary motivation for issuing a CBDC. Now, whether that is to, you know, kind of help it along with adoption, who knows? Um, Also, things like this tend to be extremely politicized, right? And it's kind of a, I think to argue against that would be rather naive, to be honest. Just thinking about kind of how society, and especially the psychology of money in general. I mean, it, it should be obvious, I think. Um, but separate topic. So other risks that are involved, talk about financial stability, and a big one they talk about is potential disintermediation of banks, essentially taking banks out of the equation, or maybe not explicitly, but like doing it as a side effect. Um, Now, whether this would be on purpose, like they did with the implementation with the national, or what was it, the National Bank Act of 1863, when they basically kind of one of the provisions of that legislation was to put a tax on state bank money, to where essentially making it extremely difficult for state banks to profit on their own using by issuing their own currency, right? Um, Something that happened back in the 19th century. Um, so that being said, they would essentially tax their currencies at such a rate. It was like I forget the exact rate. It was like 10% or something, making it extremely difficult. And so basically putting them out of business unless they converted into national banks. And I think a recent post I just put up on my website, I'd made a citation. It was like 943 charter conversions, I think, during that time. And I linked the paper in there as well. I'll link the actual post in here if you guys are interested in reading that. It's talking about how the increase in financial regulations and how the banks reacted during in between 1860 and 1870. But anyways, to continue on, um, so more generally, if banks begin to lose deposits to CBDC over time, I'm sorry, they may come to rely more on wholesale funding and possibly restrict credit supply in the economy with potential impacts on economic growth, right? And so basically, one of the fears and what they talk about for financial stability is essentially by people running to the central bank form of money, the central bank digital currencies, instead of having their typical commercial bank deposits. And by taking all those deposits out, they argue that it could increase the risk of some um, of a bank run or some other form of event that would destabilize the commercial banking industry, right? And so that's one thing to keep in mind with these, because now I'm not 100% sure on how much of a misnomer that could be, considering that banks don't really need your bank deposits anymore. Thinking about like the reserve requirement and just how banks are set up now, and I'm not 100% sure on how the nuances of how that would work, right? So, but this is one argument that they give, right? Is that essentially, if especially with an interest bearing CBDC, to where it would basically people would run to it for interest rather than um, keeping their money in a commercial bank and earning interest that way, right? Another thing to talk about is protecting monetary sovereignty. So, a significant adoption of money not denominated in the sovereign currency could limit the impact of monetary policy or the ability to support financial stability. Basically, they lose control over the money, and or they'd have less control with what they have, right? And so essentially the control they do have over the monetary system, or would have more so in this case for a central bank digital currency, it would decrease the actual real world effect it would have, right? And so a risk of stablecoins, so-called cryptocurrencies, and foreign CBDCs is that domestic users adopt them in significant numbers and use of the and use of the domestic sovereign currency dwindles, right? And so basically, the U.S. losing the world reserve currency status in a way, right? And so basically, people are not using dollars anymore or in this form of CBDCs, and they're going to other currencies for whatever reason. Because one of the things they do talk about is how every country, their needs for implementing a CBDC would be slightly different or could be different. And that's why they're talking about one of the biggest kind of challenges is to deal with the cooperation and interoperability of having many countries having a CBDC, right? And so, kind of getting that whole system to work on an international scale, they deem as a challenge. And that's one argument they do give is actually having like an actual global based CBDC, and but that's more of just a footnote at this point. Maybe it's more in depth in a separate post. The IMF or not the IMF, the BIS is one of the participants, I guess you could say, in this paper, along with a lot of uh, the world's largest central banks. So like the Swiss National Bank, Bank of Japan, Bank of England, the Board of Governors for the Federal Reserve and the Bank of Canada, and there's a few other ones in there as well. And as always, you can see it. Actually, look at the source and read this paper yourself, which will be linked in the description as always. Right. So, by offering an efficient and convenient CBDC itself, a central bank may reduce the risk of alternative units of account dominating. Right. So basically, having the best CBDC would keep the dollar's reserve currency status. Right. And just in a different form. Right. And then basically just having to balance all these. So the most valuable opportunities that encourage issuance is will be where a CBDC can support a central bank's public policy objectives, right? And so essentially, it's for the greater good, is what pretty much they always say, I guess. At least that's one way to take. It seems like a general theme, I guess I should say. Anyways, you want to see the title or the actual title page. So, central bank digital currencies, foundational principles, and core features. Here's the banks I was talking about. This is report number one, and it's an actual series between a group of these central banks. So, as always, but yeah, anyways, back out, and I'm going to leave it there. So, I'm actually finishing up packing to go back out of town for work. So, if you guys actually watch the videos in succession, then you'll know I spent the past like month or so out of town for work and heading right back out again. So it was a nice weekend and I was able to do a few videos in my house like I normally do, but not for the next couple weeks. But anyways, I'm gonna leave it there. I need to finish packing and head out. So I hope you guys have a good night and I'll see you on the next one.